All right, let's move on now. The United States and Japan have joined forces to support the yen in a rare move that signals growing concern over currency volatility.
Well, the yen had fallen to its weakest level in 4 decades, but a coordinated intervention by Tokyo and Washington has given the currency a sharp boost. The move comes as Japan deals with high import costs, a wide interest rate gap with the United States, and pressure from a weaker currency.
The yen is getting a boost after Japan and the United States carried out their first joint currency intervention in almost 3 decades. The move came after the yen slipped to its lowest level since 1986, trading near 164 against the US dollar last month.
Now, following the intervention, the yen strengthened sharply, rising above 155 against the dollar before easing slightly. And Japan's finance minister, Satsuki Katayama, said that the action was aimed at countering excessive volatility and disorderly moves in the currency market.
On Friday, 31st of July, Japan's Ministry of Finance, in coordination with the U.S. Treasury Department, conducted a coordinated foreign exchange intervention. This coordinated intervention was carried out based on the Japan-U.S. Finance Ministers' joint statement issued in September 2025 and was intended to address the recently observed excessive volatility and disorderly movements in the yen.
The United States also confirmed its involvement. President Trump called the move a signal of friendship with Japan, saying Washington was ready to help support its ally.
We have a good relationship with Japan. We're very strong, very, very strong financially. And they are, they have a weakening yen, and they wanted a little bit of help. And we're always there for Japan. Japan's been very good to us, with the exception, of course, of Pearl Harbor.
And the U.S. Treasury Secretary Scott Bessent said Washington is ready for further coordinated action with Japan if needed. He said that the Fed's foreign central bank liquidity facility supported Friday's yen intervention and even called for its capacity to be expanded to manage future market volatility.
The intervention comes as Japan faces a long-running currency challenge. The Bank of Japan has raised interest rates, but its policy rate remains well below the United States. That difference has encouraged investors to borrow cheaper yen and move money into higher-yielding assets elsewhere.
So for Japan, a weaker yen has two sides. It helps exporters like automakers and technology companies, but it also makes imports more expensive. With Japan reliant on energy imports, a falling currency means higher costs for oil, gas, and other essential goods.
Tokyo has warned that it will not hesitate to act again if the yen comes under further pressure. But analysts say long-term currency strength will depend on bigger economic factors, including interest rate differences between Japan and the United States.
Japan's Ministry of Finance is closely monitoring the situation and remains in close communication with the U.S. Treasury Department. We will not hesitate to conduct further coordinated intervention if necessary.